Welcome back to Accounting 102. In this video, we're going to cover Chapter 5, the Cost, Volume, Profit. Learning objectives. We're going to explain variable, fixed, and mixed costs in the relevant range. Apply the high-low method to determine the components of mixed costs. Prepare a CVP income statement to determine contribution margin. Compute the break-even point using 3 approaches, and then determine the sales required to earn target net income and determine margin of safety. So variable, fixed, and mixed costs. If we look at cost and behavior analysis, it's the study of how specific costs respond to changes in the level of business. Some costs change, others remain the same. It helps management plan operations and decide between alternative courses of action. Applies to all types of businesses and entities, and it's the starting point. The starting point is measuring key business activities. So activity levels may be expressed in terms of sales dollars, miles driven, room occupancy, dance classes taught, and many companies use more than one measurement base. So they'll do a combination of things because the costs are going to change, again, depending on the activity level. Changes in the level or volume of activity should be correlated with changes in cost. Activity level selected is called the activity index or driver. And that activity index identifies the activity that causes changes in the behavior of cost, and allows cost to be classified as variable, fixed, or mixed. Costs that vary in total, directly, and proportionally with changes in the activity level are variable costs. So if the activity level increases by 10%, total variable costs increase by 10%. If the activity level decreases by 25%, total variable costs decrease by 25%. The unit costs for variable costs will remain the same at every level of activity. Okay, and this is the definition of a true variable cost, that it's going to change proportionally and directly with changes in level of activity. So here's an example. Damon Company manufactures cell phones that contain a $10 camera. The activity index is the number of cell phones produced. As Damon manufactures each cell phone, the total cost of the camera used increases by $10. So if we look at the illustration to the right, we have a graph that shows that the total cost of the cameras will be $20,000 if Damon produces 2,000 cell phones, and $100,000 when it produces 10,000 cell phones. Okay, so as you produce one more cell phone, you get $10 more of cost, and that's just the direct direct variable cost. Now if we look at the unit cost, the unit cost is $10 for the camera, whether we produce 2,000 units or 10,000 units. The cost per unit is the same. It's that $10 for the camera. So you see the unit cost is flat. It doesn't change on activity. And here are the two graphs side by side. So the total variable costs are going to increase as we produce more, but the unit cost doesn't change regardless of level of production. Fixed costs are costs that remain the same in total regardless of the changes in activity within the relevant range. Unit fixed cost varies inversely with activity. As volume increases, the unit fixed cost declines, and vice versa. So since it's a fixed cost, total cost isn't going to change. As you produce more, the cost per unit is going to decrease. So examples of fixed costs are property taxes, insurance, rent, supervisory salaries, depreciation on buildings and equipment. So those are fixed. You're going to pay those, and it doesn't matter if you produce 1 unit or 1 million units, assuming it can all be done in the same building. those costs are not going to change. So in this example, it leases its production facilities at a rent cost of $10,000 per month. Total fixed costs of the facilities will remain constant at every level of activity. And this illustration shows that. We have $10,000 whether we produce 0 cell phones or 10,000 cell phones. If we looked at the per unit basis, the cost of rent will decline as activity increases. So at 2,000 units, the unit cost per cell phone is $5. So $10,000 rent divided by 2,000 units. When Damien produces 10,000 cell phones, the unit cost of the rent is only $1 per cell phone. The $10,000 again in rent divided by the 10,000 units produced. So our cost per unit decreases as our activity increases. And here's the two graphs again, side by side. Total costs remain flat over the level of production, but the cost per unit decreases as we increase production units. Review question. Variable costs are costs that A, vary in total directly and proportionally with the changes in the activity level. B, remain the same per unit at every activity level. C, neither. Or D, both A and B. The answer is D, both A and B. So it varies directly and proportionally with the changes in activity level, and they remain the same per unit. So the unit price is the same. As you increase or change production, it's going to change the total variable cost. The relevant range. So throughout the range of possible levels of activity, a straight line relationship usually does not exist for either variable costs or fixed costs. The relationship between variable costs and changes in activity is often curvilinear. For fixed costs, the relationship is also nonlinear. Some fixed costs will not change over the entire range of activities, while other fixed costs may change. We have a hint here. So fixed costs that may be changed by managers include research, such as new product development and management training programs. So they can make some decisions on changing those costs. And here's an illustration. On the left is total variable costs. So you can see that it increases a little bit more quickly at the low levels of activity, then it's kind of linear going up to the right, and then as you get up to a higher level activity, it increases at a steeper rate as well. And then on the fixed costs, being nonlinear, so we have a certain fixed costs at the low level activity, the medium level activity that costs step up but then remain flat for a while, and then looks like at about 80,000 or 80%, it steps up again and then remains flat. So they're fixed for a period of time, but as activity levels change significantly, it could be different levels of fixed costs. We sometimes say that, jokingly, all costs are variable in the long run, meaning as you go through different levels of activities that even your fixed costs are gonna change. So the range of activity over which a company expects to operate during the year is the relevant range. So if we highlight the relevant range here, you can see on the variable costs, it's going to be linear, like we talked about before. So as you increase activity levels, your total fixed variable costs are going to increase. And then total fixed costs within that range are going to be flat. They're not going to change within that range. So we can say that fixed costs don't change, variable costs are more linear in the relevant range. So another review question, the relevant range is A, the range of activity in which variable costs will be curvilinear, the range of activity in which fixed costs will be curvilinear, the range over which the company expects to operate during the year. It's usually from 0 to 100% of operating capacity. The answer is C, the range over which the company expects to operate during the year. Mixed costs. These are costs that have both a variable cost and a fixed cost component. Mixed costs change in total, but not proportionally with changes in activity level. So here we have an example, U-Haul truck rental costs for 1 day. There's a fixed cost component down at 50 there. So no matter how many miles you drive, it's going to be $50. But then you've got a variable cost, which is probably a cost per mile driven. So as you increase your miles driven, your total costs are going to increase because your variable cost component is going to go up. So that's an example of mixed cost where you have a fixed cost that's part of it, and then you also have a variable piece. So Hellenic Company reports the following total costs at 2 levels of production. We need to classify each as variable, fixed, or mixed. So we look at the 2 levels of production, 10,000 units on the left, 20,000 units on the right. If we look at direct materials, for example, at 10,000 units, it's $20,000. At 20,000 units, it's $40,000. So as my units double, my costs double. That's an example of a variable cost. If we look at the rent down at the bottom, $6,000 at the 10,000 unit level. It's also $6,000 at the 20,000 unit level. So that would be a fixed cost because it doesn't change as our activity level changes. And then maintenance, it's $8,000 at 10,000 units. At 20,000 units, it increases, but it doesn't double like our units are doubling. It just goes up slightly. That's going to be a mixed cost. So if we go through each one of these, think about what it would be, variable, fixed, or mixed. And we'll look at the answers here. So direct materials, direct labor, indirect materials are all variable. And again, if you think about our analysis in different previous chapters, those are the types of costs that are more easily assigned to a product. Those direct costs as opposed to overhead. So the fixed and mixed are more overhead type products, not exact, but it's a way of thinking about it that might help you with classifying costs into variable, fixed, or mixed. And then depreciation and rent are the fixed costs, and then maintenance and utilities are the mixed costs. Now we'll look at the components of mixed costs and the high-low method. The high-low method uses the total cost incurred at the high and low levels of activity to classify mixed costs into the fixed and variable components. The difference in cost between the high and low levels represents variable costs, since only the variable cost component can change as activities levels change. Okay, so it's better if we go through some examples than just looking at those definitions. So first we're going to determine the unit variable cost using the following equation. So we're going to take the change in total costs at the high level of activity versus the low level of activity. And we're going to divide that by the change in the activity level. So the change in costs divided by the change in activity level gives us our unit variable cost. So we'll go through an example. Metro Transit has the following maintenance costs and mileage data for its fleet of buses over a 6-month period. So we have 6 months, number of miles driven, the total cost, of each month. The difference in maintenance cost is $33,000 between the high and the low. So the high month being April, 50,000 miles driven, $63,000 total cost. And the low month of January, 20,000 miles driven, $30,000 cost. The difference in miles is 30,000. Again, the 50 minus the 20 from April to January. So for Metro Transit, the unit variable costs are $1.10 per mile because we take the change in cost, 63 minus 30, $33,000, divided by the change in activity, 50,000 miles minus 20,000 miles, 30,000 miles, $1.10 per mile is our unit variable cost. Okay, so for each additional mile we drive, it's an additional $1.10 per mile cost. Now, if we want to figure out what the fixed cost per is, we look at subtract the total variable cost at either the high or low and get that fixed cost. So we show both examples here. So if we just look at the high level, $63,000 total cost. We had 50,000 miles driven at our variable rate that we just calculated, $1.10, gives us $55,000 of variable cost. That difference is $8,000. That's our fixed cost. The fixed cost is $8,000. The variable cost is $1.10 per mile. We can do the same analysis on the low level. Again, $30,000 total cost, $22,000 of variable cost, which is the 20,000 miles driven times the $1.10 per mile. That difference is $8,000. It's the same solution, so you can use either the high or the low to calculate this, but $8,000 is our fixed cost. Maintenance costs are therefore $8,000 per month fixed plus $1.10 per mile of variable cost. And this is represented by the following equation. Total maintenance cost equals $8,000 plus $1.10 times the miles driven, which is the variable component. So then if we drive 45,000 miles in a given month, we could say our maintenance cost should be $57,500. Again, it's $8,000 fixed plus our variable, the number of miles driven times $1.10, 49,050. We add those together to get the 57,500. And then here's just a scatter plot on the maintenance costs. So as you can see, it's not perfectly linear, but it's close enough that we say that $8,000 is the fixed and the $1.10 is the variable. Another review question. Mixed cost consists of A, a variable cost component and a fixed cost component, or B, a fixed cost component and a controllable cost component, C, relevant cost component and a controllable cost component, or D, variable cost component and a relevant cost component. The answer is A, a variable and a fixed component. So we have another example here that we can work through. So the company accumulates the following data concerning mixed cost using units produced as the activity level. So we have 5 months of data, number of units produced each month, total cost each month. We're going to compute the variable and fixed cost components using the high-low method. Then using that information, we're going to write the cost equation, and then we'll estimate the total cost if the company produces 8,000 units. So if we compute the variable and fixed cost components using the high-low method, we have to find the high month in the low month. So we look at the data here. March, 9,800 units produced, 14,740 is the total cost. That's the high. May, 7,000 units produced, $11,100 of total cost. That's the low. So using that data, we get our variable cost per unit as the difference in total costs. So the high of March minus the low of May divided by the change in units produced. Again, high in March, low in May, and we get $1.30 per unit. Our fixed cost then is we take the difference between our fixed cost or our total costs. We're going to use the high month, in this case 14,740, minus our variable, which is the $1.30 we just calculated, times the number of units produced that month, so 9,800, gives us our 12,740. So 14,740 minus 12,740 gives us our $2,000 of fixed cost. Okay, could have used the low, we would have gotten the $2,000 answer as well. And that's the example showing how we do that. So next, we're going to use the information we just calculated to write the cost equation. So we have $2,000 of fixed costs, $1.30 of variable costs. So our total costs are going to equal the $2,000 plus $1.30 times units produced. So now that we have that information, we can estimate the total cost if the company produces 8,000 units, which is 2,000 plus 10,400, which is $1.30 per unit times 8,000 units. So $12,400 is our total cost if we produce 8,000 units. Now we'll prepare a CVP income statement to determine contribution margin. So CVP stands for cost, volume, profit. So it's the study of effects of changes in cost and volume on a company's profit. It's important in profit planning, critical factor in management decisions such as setting selling prices, determining product mix, and maximizing use of production facilities. So if we look at the basic components, we're going to have the volume or level of activity, the quantity. We're going to have the unit selling price. We'll have unit variable cost. We'll have total fixed cost. And then the sales mix will come into play as well. And then here's the assumptions that we are going to have using for doing this activity. So our behavior of both costs and revenues is linear throughout the relevant range of the activity index. So remember when we talked about relevant range, we have to assume that we have that linear relationship within that relevant range. Cost can be classified accurately as either variable or fixed. Changes in activity are the only factors that affect costs. All units produced are sold. And when more than one type of product is sold, the sales mix will remain constant. So these are some pretty big assumptions, but we're going to use these as assumptions to understand the concepts and go through these examples. So which of the following is not involved in CVP analysis? So we have sales mix, unit selling prices, unit fixed costs, volume or level of activity. And what is not involved is the unit fixed cost. We're going to deal with total fixed costs, but not unit fixed costs. So a cost, volume, profit income statement is a statement for internal use, classifies costs as fixed or variable. It reports a contribution margin in the body of the statement, and the contribution margin is the amount of revenue remaining after deducting variable costs. And then it reports the same net income as a traditional income statement. So we're not introducing additional costs, we're not eliminating costs, we're just reporting it in a different way. So Vargo Electronics Company produces cell phones. The relevant data for the cell phones sold by the company in June 2027 are as follows. So we have a unit selling price per cell phone. We have our unit variable costs listed. We have our monthly fixed costs listed. And units sold is 1,600. So here's how a traditional income statement or GAAP income statement looks on the left, and our cost, volume, profit income statement on the right. So you see at the top, sales are the same, $500 per unit at 1,600 units, $800,000. If we go down to the bottom where it says net income, it's 120,000 in both cases. So again, our net income is not going to change. It's just how we allocate the costs within the income statement to show it slightly differently. So on the GAAP income statement, we have our traditional sales minus cost of goods sold is gross profit, minus our operating expenses is net income. On the CVP income statement, we're going to take our sales minus our variable costs, so our direct materials, direct labor, and then our sales commission from operating expenses gets moved up because that's a truly variable cost as well. Sales minus our variable costs equals our contribution margin, and then we subtract our fixed costs to get our net income. And our manufacturing overhead moves from the gross profit up above in the traditional income statement to below as a part of a fixed cost in the CVP income statement. And again, costs aren't removed or added, we're just reallocating where they go in the statement. Contribution margin is available to cover fixed costs and to contribute to income. The equation for unit contribution margin and the computation for Vargo Electronics are as we see here. Our unit selling price is $500. Our unit variable cost is $300. So that means our unit contribution margin is $200. If we flip back, we can see that the 185, the 100, 15 is our variable costs. So that's the $300 of unit variable costs. And we get our contribution margin per unit of $200. So here we're just summarizing the CVP income statement again. And we're showing the total, which is what we walked through a couple slides ago. But then we also can show the per unit on the sales and variable costs and contribution margin. So assume that Vargo sold one more cell phone for a total 1,100 cell phones. So our sales will go up $500. Our variable cost goes up $300. Those are the unit costs. Our contribution margin goes up $200 because it's $200 per unit. Fixed costs remain the same, they're fixed. So our net income goes up by that $200, the contribution margin of one additional unit. The contribution margin ratio shows the percentage of sales, percentage of each sales dollar available to apply towards fixed costs and profits. The equation for the contribution margin ratio and the computation for Vargo Electronics are below. So it's the unit contribution margin divided by the unit selling price gives us our ratio. So for Vargo, it's $200 unit contribution margin divided by the $500 selling price. It's 40% contribution margin ratio. Assume Vargo Electronics' current sales are $500,000 and it wants to know the effect of a $100,000 or 200 units increase in sales. So at $500,000, we break even. We have zero net income. If we increase our sales by 200 units or $100,000, 200 times 500, we see what's on the right. So our variable costs are going to go up $60,000, 200 units times $300. Our contribution margin goes up $40,000, so $200 times 200 units. Fixed costs remain the same, so our profit or net income goes up $40,000. Another review question. Contribution margin is revenue remaining after deducting variable cost. May be expressed as unit contribution margin. Is selling price less cost of goods sold, or both A and B above? The answer is D, both A and B above. So it's the revenue remaining after deducting variable costs, and it may be expressed as a unit contribution margin. Selling price less cost of goods sold is gross margin. We see that on a traditional or GAAP income statement, not on the contribution margin statement or the CVP income statement. So let's go through another example. Amco Industry produces and sells a cell phone operated thermostat. Information regarding the costs and sales of thermostats during September 2027 are provided below. So we sell the thermostat for $85 per unit. We have unit variable costs of $32 per unit. Our total monthly fixed cost is $190,000. Our units sold are $4,000. So we need to prepare the CVP income statement for Amco Industries for the month of September. We want total per unit and percent of sales values. And here's what that looks like. Our sales are $340,000, $85 per unit. Our variable costs are $128,000, so $32 times our volume, and that's 37.65%. Our contribution margin is $212,000, sales minus variable costs, and we have $53 per unit. Our contribution margin percentage is 62.35%. Fixed costs are $190,000, so our net income is $22,000. Now we're going to compute the break-even point using three approaches. So break-even analysis is the process of finding the level of activity in which total revenues equal total costs. And we'll talk about total costs where it's both fixed and variable. It can be computed or derived three different ways: from a mathematical equation, by using contribution margin techniques, or from a cost volume profit graph. It's expressed in either sales units, quantity, or in sales dollars. So break-even occurs where total sales equal variable costs plus fixed costs. In other words, net income is zero. So we see an example here where computation of break-even point in sales units. So our formula, sales minus variable cost minus fixed cost is net income. We set that where our sales are $500 per unit, variable costs are $300 per unit, $200,000 of fixed costs. So 500 times quantity minus 300 times the quantity minus 200,000 equals our net income of 0. So that's what the break even is our net income is 0. We're just covering costs. If we then do the algebra equations, we get down to the fixed costs divided by the unit contribution margin to get the number of units. So in this case, $200,000 of fixed costs divided by $200 of contribution margin per unit, we get 1,000 units. Okay. So that's the mathematical equation of solving the break even. If we use the contribution margin technique, at the break-even point, contribution margin must equal total fixed cost. So our contribution margin, remember, is total revenues minus variable costs. If we set that equal to our fixed costs, we can get our break-even point. The break-even point can be computed using either unit contribution margin or contribution margin ratio. So if we're trying to figure out the break-even point in units, we use the unit contribution margin. So we take our total fixed costs divided by our unit contribution price of $200. $1,000 is our break-even point in sales units. If we're looking for the break-even point in sales dollars, the contribution margin ratio is used. And here's the equation for that. It's the fixed cost divided by the contribution margin ratio. So in our example, $200,000 of fixed cost divided by 40% contribution margin ratio gives us our $500,000 break-even point in sales dollars. And here it is using a graph. You can see our break-even point is where our sales and our total costs intersect. And where that point is, it's 1,000 units of activity or units of sales, and then it's $500,000 of sales dollars is our break-even point in sales dollars. Okay. So Ghost & Company is planning to sell $200,000 pliers for $4 per unit. The contribution margin ratio is 25%. If Ghost will break even at this sales level, what are the fixed costs? The answer is $200,000 is our fixed cost. How did we get that? Two different ways. We could take 200,000 units that they're planning to sell at $4 per unit, $800,000 of sales times 25% contribution margin ratio is $200,000 of contribution margin. At break even, our contribution margin equals our fixed costs, so that's also our fixed costs. The other way is to look at our contribution margin per unit. So $4 of sales per unit times 25% contribution margin gives us our $1 contribution margin per unit. Multiply that by the number of units, 200,000 units, it's $200,000 of contribution margin. Again, break even, our contribution margin equals our fixed cost. So Lombardi Company has a unit selling price of $400. Unit variable costs of $240 and fixed costs of $180,000. Compute the break-even point in sales units using mathematical equation, and then we'll do it for using the contribution margin. So using the mathematical equation, sales minus variable costs minus fixed costs is net income. If we set our net income at 0, our sales are $400 times quantity minus $240 times quantity minus $180,000 of fixed costs. It's going to equal 0. 160 is our contribution margin per unit times quantity minus our fixed costs of 180 gives us a quantity of 1,125 units. So that's our break-even point using the mathematical equation. Now if we use unit contribution margin to calculate the break-even point, take our fixed costs divided by our unit contribution margin, which is the $400 selling price minus the $240 per unit of variable costs, $160 per unit. To cover our fixed cost of 180,000, we need to sell 1,125 units. And finally, we'll determine the sales required to earn a target net income and determine margin of safety. Target net income is the level of sales necessary to achieve a target income. Can be determined from each of the approaches used to determine break-even sales or units. So remember, that's a mathematical equation using contribution margin technique or from a cost volume profit graph. It's expressed in either sales units or sales dollars. So we're going to look at it the same way we did for break even, but instead of setting our net income at 0, which is what we did for break even, we're going to have a target net income. So we'll set the equation equal to that target net income. Then we can use the same formulas and the same analysis. So sales minus variable cost minus fixed cost is our target net income. Okay. Remember our break even, we set that at 0. Now we're going to set a target there. So if we set our target net income of $120,000, we have $500 of sales per unit, $300 of variable cost per unit, and $200,000 of fixed costs. We set the equation, we go through, and our fixed cost plus target net income divided by unit contribution margin gives us our quantity of 1,600. So again, this is very similar to break even, where we had fixed cost divided by unit contribution. Because our target net income in a break even analysis is 0, we just ignored that. Now we just add that target net income that we want to achieve, and we can see what the quantity is that we need to sell to get that target net income. To determine required sales units, we use the fixed cost plus target net income divided by the unit contribution margin. So again, same equation as we did for break even, except that our target net income is now higher than 0, where in break even it was 0. So in this case, 200,000 plus 120,000, 320,000 divided by $20 contribution margin, $200 contribution margin gives us our 1,600 units. Sales dollars, we can use the contribution margin ratio, so 40% contribution margin. Again, it's fixed cost plus target net income, $200,000 of fixed costs, $120,000 of target net income, divided by our 40% contribution margin is $800,000 in sales that we need to get that $120,000 of desired net income. And then if we look at the graph Suppose we sell 1,400 cell phones. We go up vertically. Sales line is at 700,000. Total cost line is 620. The difference between the two amounts represents the net income or profit of $80,000. The mathematical equation for computing required sales to obtain target net income is required sales equals variable cost plus target net income, variable cost plus fixed cost plus target net income, fixed cost plus target net income, or none of the above. The answer is B. Our variable costs plus fixed costs, which is our total costs, plus our target net income is what sales level we need to hit that target net income. The equation for margin of safety in dollars. So the margin of safety is the difference between actual or expected sales and sales at the break-even point. It measures the cushion that a particular level of sales provides, or the safety margin. It may be expressed in dollars or as a ratio. So if we assume our actual or expected sales are $750,000, our break-even sales are $500,000, our margin of safety in dollars is $250,000. So we have $250,000 additional sales at our expected level or our actual level of 750 that's contributing to income above our break even. The margin of safety ratio is computed by dividing the margin of safety in dollars by the actual or expected sales. So again, assuming the $750,000 actual or expected sales, calculated the margin of safety in dollars of $250,000. So the margin of safety ratio is 33%. The higher the dollars or percentage, the greater margin of safety. So Marshall Company had actual sales of $600,000 when break-even sales were $420,000. What is the margin of safety ratio? It's 30%. Actual sales of 600 divided by the break-even sales of 420 gives us our $180,000 of safety margin. That safety margin divided by actual sales gives us our 30%. Break-even, margin of safety, and target net income. So Zoot Suit makes travel bags that sell for $56 each. For the coming year, management expects fixed costs to total $320,000. Unit variable costs to be $42. We compute the following. Break-even point in sales dollars using the contribution margin ratio. The margin of safety and margin of safety ratio, assuming actual sales are $1,382,400. And the sales required to earn a net income of $410,000. So we'll go through all of these. So compute the break-even point in sales dollars using the contribution margin ratio. So the contribution margin ratio again is our sales minus variable cost to get the contribution margin per unit divided by our sales per unit. So 56 minus 42 divided by 56. And we get 25% is the contribution margin ratio. Break-even sales in dollars is our fixed cost divided by that contribution margin ratio. So $320,000 divided by 25%. So $1,280,000 of sales, and we break even. So we'll have zero net income at that point. compute the margin of safety and margin of safety ratio, assuming sales are 1,382,400. So the margin of safety is that level of sales that we're expecting, or the actual, minus our break-even level of sales of 1,280,000 that we just computed. So at that level of sales, we have $102,400 of safety margin. We can use that to figure out our margin of safety ratio. So the 102,400, our margin of safety, divided by the actual sales, 1,382,400, and our margin of safety ratio is 7.4%. And now we want to compute the sales dollars required to earn net income of $410,000. So the required sales in dollars is our fixed costs of $320,000 plus our required net income, or our net income target that we want, $410,000. We add those together. We divide by the contribution margin ratio percentage. So that's 25%. We get $2,920,000 of sales. That's the level of sales we need to earn net income of $410,000. That's it for Chapter 5. A lot of information that we went through. I will also post some challenge exercises like I did in Chapter 4, so you can practice some of these in a little bit more detail, as well as doing the homework. As usual, if you have any questions, please don't hesitate to reach out. Thank you.